What you are currently seeing is a repositioning, not a resurgence. The markets were not astonished by the Federal Reserve's rate hike or thrilled by its rate cut. Rather, it fixed interest rates, and that one choice set off a silent but potent domino effect throughout the whole financial system. The US dollar started to lose value, housing indices started to stir, gold shot up as if something unseen had broken, and stocks started to rise. This appears to most as a return to optimism. Markets, however, perceive this as a central bank that has overreached itself. History demonstrates that significant events are likely to occur when markets move before the Fed takes action. Number 10, smart money signals. While gold prices and stock indexes make headlines, the most significant activity is taking place in the background. Inflation-resistant and rate-sensitive assets are replacing cash in the portfolios of institutional investors, such as hedge funds, pension funds, and sovereign wealth funds. Capital is shifting into industries that have historically performed better during easing cycles. Bond positioning is shifting, and volatility hedges are growing. This is a strategic defense, not an emotional trade. Because the edge vanishes once the Fed formally pivots, smart money moves before confirmation. Silent repositioning by specialists typically indicates that turbulence is approaching for everyone else. Number 9, debt pressure. Debt is one of the main reasons the Fed froze rates, and it has nothing to do with markets. During years of cheap money, consumer, business, and government debt have all skyrocketed. It's getting more and harder to pay off the debt at the present interest rates. Increased rates endanger solvency, in addition to slowing growth. Although it saves time, a rate halt doesn't address the issue. Indeed, it subtly affirms that extreme tightening is no longer acceptable for the system. Regardless of what the Fed says in public, markets are betting on further easing because they recognize this fact. Number 8, global ripple. The Fed is not an isolated entity. The whole global financial system responds when U.S. interest rates freeze. A declining dollar helps emerging markets, makes foreign stocks more appealing, and causes global capital to start shifting. Other central banks are compelled to react at the same time, either by lowering interest rates or by running the risk of capital flight. This has a cascading effect that makes monetary policy more accommodating globally. In reality, what appears to be a single Fed decision is a global liquidity signal, and history demonstrates that once this process begins, it is very difficult to halt without a significant shock. Number 7, the Fed's move. The Fed's rate freeze is not a sign of stability, it's a sign of constraint. Inflation remains above target, yet the economy is buckling under the weight of elevated borrowing costs. Consumer credit stress is rising, business investment is slowing, and government debt servicing costs are quietly exploding. By holding rates steady, the Fed is admitting that further tightening risks triggering a recession or a financial accident, while easing too soon risks reigniting inflation. This pause represents the narrowest part of the policy tunnel, where every possible decision carries consequences. Markets don't see patience here. They see hesitation, and hesitation from a central bank is one of the strongest signals that a policy reversal is approaching. Number 6, stock market reaction. Stocks are rising not because economic fundamentals suddenly improved, but because monetary pressure stopped getting worse. Equity markets are forward-looking systems that price future conditions months in advance. Once investors realized there would be no more rate hikes in the near term, the valuation ceiling lifted. Lower expected rates in the future mean cheaper capital, higher profit multiples, and renewed appetite for risk. Large institutions are aggressively positioning now because they know the biggest gains occur before rate cuts are officially announced. This surge isn't retail excitement, it's institutional anticipation. Markets aren't celebrating strength, they're discounting policy retreat. Number 5, gold's warning. Gold's surge is the most honest reaction in the entire market. Gold doesn't care about narratives, it responds to monetary reality. When interest rates freeze while inflation risks remain unresolved, real yields begin to erode. That environment punishes cash and rewards hard assets. Investors are turning to gold, not because they expect growth, but because they expect currency dilution and policy errors. Central banks themselves have been accumulating gold for years for this exact scenario. Gold's rise is not about optimism, it's about trust slowly leaving the system. Number 4, housing awakening. Housing is beginning to move because expectations have shifted. For months, high mortgage rates crushed affordability and froze demand. But the Fed's pause has changed psychology. Buyers are no longer waiting for perfect conditions. They're trying to avoid missing the bottom. Even small declines in mortgage rates dramatically increase purchasing power, especially in markets with limited inventory. At the same time, sellers are reluctant to lower prices, creating a supply choke. This combination often leads to sudden price acceleration. Housing doesn't recover gradually, it snaps back when confidence returns, and that confidence is quietly rebuilding. Number 3, dollar decline, the U.S. A dollar's global dominance is built on yield and confidence. When U.S. rates were rising aggressively, capital flooded into dollar-denominated assets. A rate freeze breaks that advantage. As markets begin pricing in future easing, global investors rotate capital into higher growth regions, commodities, and alternative stores of value. A weakening dollar supports stocks and gold, but it erodes domestic purchasing power and increases long-term inflation risk. This isn't a dramatic collapse, it's a controlled bleed, which is often far more dangerous because it goes largely unnoticed until the damage is done. Number 2, the Fed's trap. The Federal Reserve is now stuck between two unacceptable outcomes. If inflation rises again, aggressive rate hikes would risk breaking the economy, destabilizing debt markets, and triggering financial stress. If growth slows meaningfully, rate cuts become unavoidable, even if inflation remains elevated. Both paths weaken the currency and inflate asset prices. This is the trap markets see clearly. The Fed no longer controls outcomes, it reacts to them. That realization is why money is moving early, before official policy changes force dramatic reprising. Number 1, what comes next? The next phase will not be calm. If inflation cools, rate cuts will fuel asset inflation and widen wealth inequality. If inflation resurges, volatility will spike as markets challenge the Fed's credibility. Either way, holding cash becomes increasingly costly, while real and financial assets continue repricing higher. Most people will wait for confirmation headlines, speeches, official pivots. By then, positioning will already be complete. Markets always move first. Explanations come later. This wasn't just a pause, it was the moment markets realized the Fed has limited moves left. If you want to understand where money goes before the crowd notices, hit like, subscribe, and turn on notifications. Because in this cycle, reacting late isn't a mistake, it's a loss.